Good morning, everybody. Happy Monday. It's March 20th, 2023. Great to be with all of you today. My name is Bob Lang, and I run explosiveoptions.net along with an amazing, wonderful, fantastic chat room every single day. We have almost 250 people in the chat room who come and go, but mostly stay all day long. It's a great place to be. And if you're new to the program here and you get a chance to try out our chat room, I think it's a game changer for you. So come on in and see what we're doing. I'm in there all day long. So let's talk about markets here. So we see futures are up a little bit this morning. We're up. We've been bouncing around, of course, up about 9 handles on the S&P right now. Dow Industrial's up about 60. But let's look at what happened from the opening last night until where we're at right now. So as you can see here, last night, Sunday, we opened up sharply higher and rallied around and then started sliding a little bit in the middle of the night. And about 2 o'clock in the morning, I think when Europe opened up, we fell really hard right over here. Came down about we were at 39.43 at that point in time. We came all the way down to 39.05, about 40 handles in about 5, 10, 15, 20, 25, 30 minutes, right? Bounced around a little bit, made our low. We were down about 40 or 45 handles. We had broken the 3,900 level. We went all the way down to 38.97, and now we're at 38.56. So we're 50, 60 handles above where we were at the lows. We bounced back sharply over here. So, this is volatility, folks. This is what the markets are giving us right now. We have high volatility right now. We see the VIX is up this morning. It was up a lot more earlier. We're up about 26%. The VIX futures were up actually above 26. Now we're back down below. So we're going to see a lot of this volatility going on as news continues to hit and people try and put some color on what's happening. So what was the news that happened over the weekend? Of course, if you were paying attention and watching what was going on and hearing things, you heard that Credit Suisse was bought out by UBS, which is the United Bank of Switzerland, in a take under, not a takeover. So they bought them for about I think $3.6 billion. The bank, Credit Suisse, went out on Friday at a valuation of $8 billion. So it was a super disappointment for anybody who was a shareholder of Credit Suisse. Frankly, I don't know anybody who would be. His stock's a $2. Stock was trading at $2 or so last week. The bank is atrocious. So it's good that UBS kind of put them out of their misery here. But who knows what other problems there are. You know what? When you see one cockroach, there's always another one or a few others lurking right behind. So we could have some other problems with other banks down the road. And this is the reason why volatility is so elevated right now. It's so moving around. Markets are moving around a lot because it's this level of uncertainty which is extremely high right now. And when uncertainty is elevated like this, anxiety and stress and fear starts to bubble up to the surface. So that's what we're having right now. But I think there's a lot of people out there who think that when the markets got slammed a couple weeks ago and then down a little bit towards the end of last week, they're bargain hunting here. I think it's a dangerous move because especially until we know more information, I think the better move for at least for me, for a lot of people in the chat room, is to step aside a little bit, play small, and just wait until some more information comes out. And then if we see some sort of movement in the markets, I'm a momentum trader. I like to trade the momentum up. I like to trade it down. When we get some movement in the markets and we see some volume coming in, we see the indicators starting to move in a certain direction. I'll share with you here. Here's what the indicators looked like last week. We have the VOLD. We have the ticks over here. We also have the ticks for the NASDAQ and then the ADD. So you can see pretty much Wednesday straight down. all you had to do was step in here after a couple of bars over here and ride this down. You also had a strong up day on Thursday, and then we reversed hard on Friday. And again, all day long, the markets were down sharply. So, again, this is one of these markets. I told the class on Saturday, we have to make an assessment each and every day of how we're going to play the markets and how things are going to go. That's just the market that we're in right now. You can't really feel comfortable if you're holding positions, a lot of positions, that is, overnight, right? Because you just don't know what you're going to get. Of course, Thursday was a really strong up day, and we reversed almost everything on Friday, right? Just about everything on Friday, and then some. So in a continuation from Wednesday, but what, we didn't really continue Wednesday. Went down Wednesday, bounced up Thursday, right back down on Friday. So I'm going to show you a couple other charts that I've been looking at lately, and it bears repeating here. Again, of course, this is the one that I point out quite a bit. This is the stocks trading above their 50-day moving average. And the way I look at this is, if you're trading in the box, if we're trading in the box in this particular one, that's no good. And the more time we spend in the box, which means it's below 50% of the stocks in the S&P 500, the more better chance that we have sellers coming in and can just continue to sell the rips and not buy the dips. So when we had this penetration here, we tried to get above there at the early part of March and failed. This is telling you a lot. This is we're at 22 on this indicator. So what does this mean? If you take the flip side of that, it means 78% of stocks in the S&P 500, almost 400, are in bear markets. Anything below the 50-day moving average, they're in bear markets, right? So, trying to find the 1 out of 5 stocks that is not in a bear market, that's tough work. That's hard to do, right? So instead of trying to find that needle in the haystack or the diamond in the rough, why not just find a whole bunch of diamonds, right? And just go to the diamond place to find the winners. And where are the winners? The winners are what's happening with the trend and what's happening with momentum in the market. The winners you can find are going down, right? You could trade the markets to the downside, even today when the markets are up right now. So, I reiterated this tweet last week. And I say it all the time. I said, people come up to me and they say, Bob, it's easy to make money in a bull market. I just want to make money in a bear market. Well, making money in a bear market does not necessarily mean you have to make money when the markets are going down. You can make money when the markets are going sideways. You can make money in a bear market rally, right? I've seen some of the most spectacular rallies in bear markets than you've ever seen. We saw several of them last year. So we're still in a bear market. That is just the context and the environment that we're in. You can make money going up. You can make money going down. You can make money when the markets are going sideways, right? We are still in a bear market. How do I know that? Well, I always refer to this chart here, the S&P 500. Oh, sorry here. What's the monthly chart look like on the MACD, right? I always look at this, right? It looks like an uptrend. Sure, longer term uptrend is still intact here, right? But let's look at this MACD over here. When the MACD is the black line is below the red line, it simply means, oh, here's my trading assistants over here. Hello. When the black line is below the red line, it means we're in a bear market. Okay? Bear markets don't necessarily have to go down. Remember, my definition of a bull and bear market is a bull market is one that goes up. A bear market is one that doesn't go up. What is that? What's the difference between a market that doesn't go up and a market that goes down? A market that goes sideways, right? What if I told you that for the entire year of 2023, we're going to be trading within a range of, say, 4,200 on the high side, which we saw in January, and say 3,600 on the downside, 600-point range. That'd be That'd be awful, wouldn't it? It'd be really hard because every time you try to buy a breakout, we'd reverse down. Every time we try to buy a bottom, we reverse back up, or sell a bottom, we reverse back up. So I don't know if that's going to be the case, but it certainly looks like it's playing out that way. And I mean, it's far different than look at the range we had in 2020. Okay, look at the range we had in 2021. Huge range, right? 3,900 all the way up to 4,800, 900-point range. In 2022, 48, 4,600, 4,800 at the beginning of the year in 2022, all the way down to 3,500. So 1,300-point range, 900-point range. In 2020, huge range, right? Went all the way down to 2,000, and we closed up near 30, 36, 3,700. 1,500-point range. So if I tell you it's only a narrow 600-point range, that's going to be tough, right? It'll be difficult to trade that. So, we have to be aware of the environment and the landscape that we're in and make adjustments accordingly, right? Now, we do have a Fed meeting coming out this week. We'll be meeting here on Daily Bites after that Fed meeting is over. So what will I be watching on for the Fed meeting? I'll be listening to, I'll be reading the statement. I'll be listening to Powell on Wednesday in his press conference. And I'll be reading and paying attention to what they're saying about inflation. If they're really worried about this whole banking crisis that we're in right now, or if they feel that, hey, listen, we've done enough and that's all you're going to get. And we're going to continue to move on and fight inflation. We saw inflation numbers last week that were extremely hot on the consumer price index, CPI. Anybody not believe that, you're crazy, because the numbers were still very hot, much hotter than what the Fed is looking for, right? So if anybody's looking for the Fed to pivot like they were last year, I think you're missing it here. Now I realize that bond prices have gone up, and yields have come down sharply over the past week and a half, and I think it's been driven by the fear that there's going to be bank runs and that there's nothing, that there were not enough things in place to lock that down. I think that now, especially bank runs tend to happen when the media goes into a frenzy and starts talking about it, starts warning everybody, hey, you better go to the bank and withdraw all your money from the ATM or whatever, go out and get a check and get your bank, because XYZ bank is going to fail. I don't know if that's happening anymore. Certainly, we did have our share of scares and worries here with Silicon Valley Bank, Signature Bank, and a couple of other names as well too, that looked like they were going to cause a bank run, but fortunately that didn't happen. I think that the clarity that we get from the Fed this week, I'll also be watching. Don't forget, when they come out with their statement, they're going to also be coming out on Wednesday with their projections about GDP, unemployment, inflation, and Fed funds rate. So going forward, so they change these projections every few months. The last time we saw those projections was in December. The one thing that I'm thinking that they're going to change quite a bit is they might slightly downgrade inflation a little bit for the rest of this year and into 2024. But I think that the one change that they're going to big change they're going to make is to the GDP, right? And I think because this first quarter is looking like it's going to be a strong quarter. We only have about 2 weeks left to go in the first quarter. The projections seem to think that we're going to have a pretty strong first quarter. Jobs were strong in January, and of course we did see a pretty strong number in February. We'll have the next jobs report for March coming out in the early part of April. I think that is going to lead to an upgrade in GDP. Remember, at the end of December, the projections for GDP for 2023, 0.2, basically a flat or a zero return for the United States in GDP. So I think that's going to get upgraded a little bit. How the market's going to react to that, I don't know. I think more likely they're going to react and respond to what's happening with the Fed funds rate. Now, is there some kind of correlation between a strong GDP and Fed funds? Seems to be, because the Fed is saying that the economy is too hot right now, and they can continue to raise interest rates into a hotter economy, right? So I think that it's one of those situations where be careful what you wish for, right? We like to see the economy growing, we like to see job growth and so forth, but at what cost? And the cost here, what the Fed has been talking about, is the cost of high inflation, and it's not coming down fast enough. So I know that Fed funds futures have not been portraying a large amount of rate cuts coming in. Actually, they've come down quite a bit. Still looking at a 70% chance of a 25 basis point rate hike next week, or this week, excuse me. Fed in May, we're looking at about a 50% chance of a pause in May, and then go all the way out to July. It's actually projecting that we're going to be back to where we are right now, 4.5%, right? Maybe even lower than that. So it's crazy. Go up and right back down again. I don't know. I think the Fed funds futures market is not reading the Fed correctly. Of course, we haven't heard anything from them yet, so we don't know. This is going to change a lot. All right. Last chart I want to show you is the VIVIX, VVIX. This is the volatility of volatility. It's not the VIX, it's the VVIX, right? And we can see that last week, a week and a half ago, this started to get active again. It was been flattening out a little bit and hitting some multi-year lows. But look at what happened. We saw the volatility of volatility. Now, this is a derivative. It just tells you how active volatility is in the markets. We saw the VIVIX move from about 75 all the way up to where it is right now, 124. That's up about 75% in just a couple of weeks. So it means that the worry and the fear in the market is palpable right now. It's moving higher as well too, and so we can expect big ranges to come in the markets, and certainly we've seen that for the past just overnight, right? We went from plus 28 to down 45. Now we're up 18. So just be aware that we're going to have some big movements over here going forward. Now, if the volatility falls hard after the Fed meeting Tuesday and Wednesday, it might be game on for the bulls. So at least for a little while, like we had last Thursday. So that's gonna be it right now. I'm gonna lay it down. Have a great day, everyone, and I appreciate all of you listening. I hope you have a chance to read the daily bites that I put out. The market blast that came out this morning. I'll be putting I put that out every single day. And finally, go Aztecs, San Diego State, big win on Saturday over Furman. And bless you. And they're going to be playing Alabama on Thursday night. So have a great day, everyone. Hopefully you got a chance to watch that. And listen, as far as the markets are concerned, just take it slow, take it easy, find some ideas that work for you, and go with them, and keep it small. Remember, it's the bear market playbook that we're using every single day. All right, have a great day, everyone. Take care. Bye-bye.